Today, I want to slow things down and share something important with you because a fresh report has just come out from one of the biggest and most powerful banks on Wall Street, and what they are saying could change how many people think about metals in the months ahead. This report comes from JPMorgan, and it was released on February 5th, and it focuses closely on gold, silver, and copper, which are three metals that many investors watch very closely during uncertain times. Before we break anything down, I want you to understand why this matters, because when a bank like JPMorgan speaks, markets tend to listen, especially long-term investors in large institutions. According to their latest technical strategy report, all major metals are expected to enter a period where prices move sideways instead of sharply higher or lower, and this phase could last weeks or even months. Gold, silver, and copper are all included in this view, and on the surface, that may sound boring or even worrying to some people who were expecting fast gains. But here's the key point that most people will miss when they only read the headline, do not dig deeper into the details of what JPMorgan is actually saying. The sideways movement does not mean the bull market is over, and it does not mean the long-term trend has failed or reversed in any meaningful way. JPMorgan is very clear that this phase is simply a pause, a reset, and a chance for the market to cool down after strong moves higher. Think of it like a long road trip where the car needs to pull over for fuel and rest, not because the journey is finished, but because it needs to continue safely. In their own words, the analysts describe this period as a necessary break within a much larger upward trend that is still very much alive. The way I like to explain it is simple and human, because markets behave like people, and people cannot run at full speed forever without stopping. The music has not stopped, the show is not over, and the crowd has not gone home. The band is just taking a short break before coming back on stage. Before we go deeper, I want to pause for a moment and hear from you, because this channel, Alex Carter Reports, is built around real conversations, not one-way lectures. Drop a comment and tell me where you are watching from today, whether that is the United States, Europe, Asia, the Middle East, Africa, or South America. This community reaches far across the world, and I always like to see how global this discussion really is, especially when we are talking about assets that affect everyone. While you are typing that, let me ask you another honest question that has no right or wrong answer. Do you believe gold will reach new all-time highs in the next 60 days, or do you think prices will move lower first before that happens? I want your real opinion, not what you think sounds smart, because gut instincts often reveal how people are truly positioned emotionally in the market. I read every single comment, and I pay attention to the tone and the mood, because sentiment matters more than many people realize. Let me also be very clear about something, because transparency matters deeply to me and to Alex Carter Reports. I do not sell courses, I do not sell trading signals, and I do not run paid groups or private memberships of any kind. What you get here is open analysis that looks at both sides of every situation, so you can decide for yourself what makes sense for your goals and your timeline. Many viewers have reached out over time to say that this approach helps them cut through the noise and avoid emotional mistakes. That feedback is the main reason I keep doing this, because clarity is far more valuable than hype in markets like these. If you want to connect with others who follow this channel in real time, there is a WhatsApp group linked below where people share thoughts and observations. You can also follow Alex Carter Reports on X, formerly known as Twitter, which are the only platforms outside YouTube where I am active. If you ever see anyone claiming to represent this channel somewhere else, block them immediately, because scams are real and protecting yourself matters. Now let us get into the actual JPMorgan report and why it matters for your portfolio and your expectations moving forward. This report was written by Jason Hunter, who works on JPMorgan's global market strategy team as a technical strategist. That title is important because technical strategists focus on charts, price behavior, momentum, and historical patterns, rather than company earnings or economic stories alone. Technical analysis helps explain crowd psychology, market positioning, and where prices are likely to pause, struggle, or find support based on past behavior. According to Jason Hunter, the recent movement in gold prices fits a very common pattern seen after strong rallies. He explains that what we are seeing now is not the end of the gold trend, but a short-term reversal after prices moved up very quickly. In simple terms, gold ran hard, got tired, and now needs time to rest before deciding on the next move. JPMorgan makes a very clear distinction between a pause and an ending, and that difference matters more than almost anything else in this report. A pause means the trend is still alive, while an ending means something is broken, and JPMorgan does not believe anything is broken right now. They believe gold is simply catching its breath after what they describe as a parabolic rise earlier. When traders say something went parabolic, they mean prices moved up faster and faster, almost straight up on the chart. Moves like that feel exciting, but they are never sustainable for long periods of time. Eventually, buyers get exhausted, sellers step in, and the market needs time to rebalance. JPMorgan expects gold prices to move back and forth within a wide range, instead of trending strongly in one direction for a while. This means investors should expect choppy action, sudden swings, and emotional price moves that do not clearly point up or down. In other words, do not expect an easy ride or a straight line because consolidation phases are messy by nature. Now, let us talk about the specific price levels that JPMorgan says are most important to watch during this phase. On the upside, the $5,000 level is seen as a major area where gold could struggle if prices attempt to rise quickly. Above that, the zone between $5,100 and $5,150 is viewed as even stronger resistance that could stop rallies in the short term. On the downside, the first level to watch is $4,500, which lines up with a commonly watched moving average. But the more important support area, according to JPMorgan, sits between $4,264 and $4,381. This zone acted as a breakout area in late 2025, and they expect it to attract buyers again if prices move lower. These levels are not guesses or emotions. They are based on technical structures that large institutions actively monitor. Right now, gold is trading near the middle of this range, which means it is neither extremely cheap nor extremely expensive by these standards. The positioning fits perfectly with the idea that the market is resting rather than breaking down. Now, let us move deeper into why JPMorgan still believes the long-term case for gold is strong, even while prices move sideways in the short term, because this part of the report explains the bigger picture. JPMorgan says the main force behind the gold bull market has not changed, and they describe this force with one simple but powerful idea called currency debasement. That phrase may sound complex, but the meaning is very simple when you strip it down to real-life terms that everyone can understand. Currency debasement happens when governments print more money, spend more than they earn, and slowly reduce the buying power of their currency over time. When this happens, people need more dollars to buy the same goods, services, and assets. And that is when hard assets like gold start to shine. Gold does not rely on promises, governments, or balance sheets, which is why it has held value for thousands of years across many different civilizations. JPMorgan makes the point that this process has been happening for decades, but it has clearly sped up in recent years. Massive government spending, rising debt levels, and ongoing budget deficits have created an environment where paper money loses strength over time. When currencies weaken, investors naturally look for stores of value, and gold has always been one of the first places they turn. This is not a new story, but it is one that continues to play out again and again throughout financial history. The report highlights the US dollar index, often called the DXY, as a key piece of this puzzle. The DXY measures the strength of the US dollar against a basket of other major currencies around the world. According to JPMorgan, the fact that the dollar index remains below the 100 level is a major long-term warning sign for the dollar itself. They view this level as a dividing line between strength and weakness, and staying below it suggests ongoing pressure on the currency. As long as the dollar remains weak, gold has a strong tailwind behind it, even if prices pause in the short term. JPMorgan points out that the dollar could easily resume the downward trend that began in early 2025 if this weakness continues. If that happens, it would likely push investors back toward gold as protection against currency erosion. So while gold prices may move sideways for now, the underlying forces that support higher prices remain in place. This is why JPMorgan does not see the current phase as a top or a breakdown, but rather a reset before the next move. Another signal JPMorgan discusses is one that many retail investors never look at, but professionals watch very closely. That signal is the ratio between the S&P 500 and the price of gold. This ratio shows how stocks are performing compared to hard money, and it gives insight into where capital is flowing. When the ratio rises, it means stocks are outperforming gold, and when it falls, it means gold is outperforming stocks. According to JPMorgan, this ratio recently broke below a support level that had held for nearly 10 years. That kind of break is rare, and when it happens, it often signals a major shift in investor behavior. JPMorgan says this breakdown looks very similar to patterns seen in the late 1970s. That period is famous in market history because it led to one of the strongest gold and silver bull markets ever recorded. During that time, gold rose from around $100 to over $800, and silver surged from about $5 to nearly $50. And JPMorgan is not saying history will repeat exactly the same way, and neither am I here on Alex Carter Reports, but history often moves in familiar patterns, even if the details are different each time. What matters is that a major bank sees structural similarities between now and that earlier period. That alone is enough to deserve serious attention from anyone watching metals. JPMorgan concludes that capital continues to flow toward hard assets over the long term, even if prices cool off temporarily. They describe the current phase as a moment to digest gains rather than give them back. One analyst even compares it to halftime in a game, where players rest, adjust strategy, and prepare for the second half. The game is not finished, the scoreboard still matters, and the second half is still ahead. This idea resonates strongly with long-term investors who have been watching gold and silver for many years. Many people in this community have been holding or stacking metals long before prices became exciting again. Others are new and trying to understand why metals suddenly matter so much to the global conversation. Both perspectives are important, and both are welcome here at Alex Carter Reports. What matters most is understanding where we are in the cycle, not reacting emotionally to every price swing. Now, this is where the JPMorgan report becomes even more interesting because it does not treat all metals the same. Gold, silver, and copper may all be consolidating, but the reasons behind their movements are very different. Gold is currently dealing with crowded trades, meaning too many investors rushed in at the same time for the same reason. When that happens, markets often need to shake people out before continuing higher. Profit-taking after a strong rally also adds pressure as traders lock in gains and step aside. Copper, however, tells a different story according to JPMorgan. Copper benefits from currency weakness just like gold, but it also has another powerful driver behind it. That driver is global economic activity, including manufacturing, construction, and industrial growth. JPMorgan refers to this as pro-cyclical rotation, which simply means copper rises when the real economy improves. Factories, power grids, electric vehicles, and infrastructure all depend heavily on copper. When demand for these things increases, copper demand follows naturally. This gives copper two strong tailwinds instead of one, which makes its position unique. JPMorgan believes this is why copper may resume its upward trend before gold does once consolidation ends. For investors looking ahead to the second quarter, this distinction could be very important. The report notes that copper recently pulled back after reaching above $14,000 per ton, which raised concerns for some traders. At first glance, it looked like prices might be running ahead of real economic data. JPMorgan examined this through deeper analysis and compared copper with other assets tied to manufacturing. They looked at analog semiconductor stocks, which are closely linked to industrial demand. These stocks are often used in cars, power systems, and factories, making them a good comparison point. JPMorgan found that these stocks are also pricing in a stronger manufacturing environment ahead. Both copper and semiconductors suggest that global manufacturing activity could improve later this year. This alignment across different markets strengthens the case that copper is not overpriced without reason. Instead, the market appears to be looking forward, not backward. JPMorgan concludes that copper's recent pullback looks more like a technical pause than a collapse in demand. The structure remains healthy, and selling pressure has been less aggressive than what we have seen in gold. Now let us focus on the exact price levels JPMorgan is watching for copper, because this is where their analysis becomes very practical and useful for investors and traders alike. JPMorgan believes that understanding key levels is essential during consolidation phases because price often reacts strongly when these zones are tested. For copper, the first area they are watching closely is the range between $12,074 and $12,105. This zone is seen as initial support, where buyers may step in if prices pull back further in the short term. JPMorgan considers this area a reasonable entry point for tactical traders who are looking to take advantage of market swings. If copper dips into this range and holds, it suggests that demand remains strong beneath the surface. The more important level, however, sits lower and carries much more weight for the long-term trend. That critical zone is between $11,100 and $11,200, which JPMorgan identifies as a multi-year breakout area. As long as copper stays above this range, the long-term bull market structure remains intact in their view. This is the line in the sand that separates a healthy pause from a deeper problem. If prices were to fall below $11,100 and stay there, it would raise serious concerns about the strength of the trend. But as things stand now, copper remains well above that level, which supports the bullish long-term case. JPMorgan also notes that copper reached a medium-term target between $14,000 and $14,590 or so before pulling back. Reaching a target does not mean the trend is over. It simply means the market achieved what it set out to do for that phase. After strong moves like that, it is normal for prices to slow down, retrace, or move sideways. What matters most is how the market behaves during that pause, not the pause itself. So far, copper has not shown the kind of sharp selling pressure that would suggest panic or structural weakness. Instead, the pullback appears controlled, measured, and consistent with a technical reset. This is why JPMorgan believes copper could lead the next move higher once consolidation ends. Now, let us shift our attention to silver, because many people watching Alex Carter Reports are especially interested in this metal. Silver is often misunderstood because it does not behave exactly like gold or exactly like copper. JPMorgan highlights silver's dual nature as one of its most important features. On one hand, silver acts like a precious metal that responds to currency weakness and financial stress. On the other hand, silver also behaves like an industrial metal tied to manufacturing and technology demand. About half of silver demand comes from industrial uses such as solar panels, electronics, electric vehicles, and advanced data systems. The other half comes from investors and jewelry buyers who see silver as a store of value. This split personality makes silver more volatile than gold, but also more flexible in different market environments. During monetary stress, silver often moves with gold, reacting to currency weakness and inflation fears. During economic expansion, silver can also benefit from rising industrial demand like copper. Because of this, silver often sits somewhere between gold and copper in terms of timing and behavior. Right now, silver is trading around $77 per ounce in international markets. Recent price action has been extreme, including a sharp drop of about 38% from all-time highs, followed by fast rebounds. Moves like this can be emotionally exhausting for investors, especially those who are newer to the market. JPMorgan believes silver is also entering a consolidation phase, rather than starting a new trend right away. This means prices may move back and forth within a range, instead of breaking sharply higher or lower. For silver investors, this kind of environment rewards patience more than perfect timing. Trying to catch exact tops or bottoms during consolidation often leads to frustration. JPMorgan suggests focusing on support and resistance levels instead of chasing fast moves. Because silver is linked to both gold and copper, its bottom may form somewhere between the two. Industrial demand gives silver some support when economic expectations improve. Monetary demand gives silver support when currencies weaken and confidence falls. This combination makes silver an interesting middle ground option for those who want exposure to both themes. Now, let us address a question that many of you are probably asking right now. Does this consolidation phase represent a buying opportunity, or is it better to wait for lower prices? There is no single correct answer, but JPMorgan presents arguments for both sides. The bullish case is clear and easy to understand. JPMorgan openly states that this is a pause, not the end of the bull market. The forces driving metals higher over the long term are still in place. Currency debasement continues, the dollar remains weak, and hard assets remain attractive. From this perspective, consolidation allows investors to buy at better prices than during breakouts. JPMorgan even provides specific levels they believe offer value. For gold, they highlight the $4,264 to $4,281 range as a strong support zone. For copper, they highlight the $12,070 to $12,105 range as an attractive area for buyers. If prices reach these levels, technical analysis suggests demand may return. However, there is also a cautionary side that should not be ignored. Consolidation phases can be slow, confusing, and emotionally draining. Prices may move lower before moving higher, testing patience and conviction. Buying too early can lead to weeks or months of paper losses before trends resume. There's also no guarantee that support levels will hold perfectly. Technical analysis is a tool, not a crystal ball. Unexpected events or changes in fundamentals can always shift market direction. This is why JPMorgan, along with many wealth managers, favor staggered accumulation. Instead of investing all at once, capital is spread across different prices and times. This approach reduces timing risk and smooths out volatility. It allows investors to participate without needing perfect accuracy. During choppy markets, flexibility often matters more than boldness. Now let us step back and look at the bigger commodities picture, because JPMorgan also discussed oil, and oil plays a quiet but important role in how metals behave. According to the report, Brent crude oil is expected to trade within a range rather than break out strongly in either direction in the near term. Recent price gains driven by global tensions have started to face resistance in the upper $60 area. JPMorgan believes a clean move above $70 is unlikely right now, at least without a major new shock. However, oil is not expected to collapse either, because strong technical support sits between 61.75 and 62.18. These moving averages act like a floor, helping prevent deeper declines during periods of uncertainty. Oil matters to metals investors because oil prices influence inflation expectations across the global economy. Inflation expectations affect central bank decisions, interest rates, and currency values. Currency values, in turn, directly impact gold, silver, and other hard assets. When oil is stable and range-bound, it removes one major variable from the equation. This allows the metals market to respond more clearly to its own supply and demand dynamics. Now let us talk about geopolitics, because even during consolidation phases, global tensions never disappear. Trade disputes between major economies continue to simmer beneath the surface. Political uncertainty remains elevated in many regions around the world. Central banks continue to buy gold at record levels as part of long-term reserve strategies. Many countries are slowly reducing their reliance on the US dollar in global trade and reserves. This process is slow, but it is ongoing, and JPMorgan acknowledges it as a long-term supportive factor for gold. These forces do not push prices higher every day, but they shape the long-term direction. Consolidation phases do not erase these drivers. They simply pause the price action. For patient investors, these pauses can offer opportunities rather than threats. One of the most important points JPMorgan emphasizes is the danger of emotional decision-making during consolidation. Sharp swings inside a range can trigger fear, frustration, and overreaction. Buying because of excitement or selling because of panic usually leads to poor outcomes. Having a plan matters more during sideways markets than during trending ones. Knowing your levels, your risk tolerance, and your time horizon helps prevent costly mistakes. Short-term traders and long-term investors should behave very differently in this environment. Traders may look to buy support and sell resistance while managing risk tightly. Investors with long-term views should treat daily price moves as noise. According to JPMorgan, the long-term trend in metals remains higher despite the current pause. Using consolidation to slowly build positions at favorable levels may be more effective than chasing breakouts. Staggered buying helps reduce stress and improves discipline. Position size matters, especially in volatile markets. Over-leveraging during consolidation often leads to forced exits at the worst possible time. Patience and restraint are underrated skills in investing, but they often separate success from failure. Now let me summarize the key points from this entire JPMorgan report in a simple and clear way. JPMorgan expects gold, silver, and copper to move sideways for a period that could last weeks or months. This phase is expected to include volatility, sharp swings, and false signals. Importantly, this is not viewed as the end of the bull market. JPMorgan describes it as a halftime break, not a trend reversal. Currency debasement remains a powerful long-term driver for precious metals. The US dollar remains weak, below the 100 level on the DXY. The S&P 500 to gold ratio has broken down in a way that resembles past periods before major metals rallies. Copper stands out because it benefits from both currency weakness and economic growth expectations. JPMorgan believes copper could resume its upward trend before gold in the next phase. Specific price levels matter during consolidation and should be respected. For gold, resistance sits near $5,000 and between $5,100 and $5,150. Support appears near $4,500, with stronger buying interest between $4,264 and $4,281. For copper, initial support sits between $12,000 and $12,105. The critical long-term support zone for copper is between $11,100 and $11,200. Silver remains volatile due to its dual role as both a monetary and industrial metal. Silver may find support between the timing of copper and gold movements. Staggered accumulation is favored over all-in buying during uncertain periods. Emotional reactions to short-term price moves should be avoided. Having a clear plan and realistic expectations is essential. JPMorgan's overall message is not one of fear, but one of patience and preparation. The metals rally has paused, but the underlying story remains intact. How investors behave during this pause may shape their results when the next trend begins. Stay focused, stay disciplined, and stay informed. That is the goal here at Alex Carter Reports. Watch the data, respect the levels, and avoid the noise. I will continue to monitor these markets closely and share updates as conditions change. Thank you for spending your time here today. I will see you in the next video.